Hello dear viewers, this video will be about why Blackstone's $1.8 billion senior housing gamble is now collapsing. Enjoy watching.
A much larger tale is taking place at Wall Street's most influential private equity business. While everyone has been preoccupied with individual homeowners losing equity, Blackstone's $1.8 billion senior housing gambit, which started in 2016 when demographic trends appeared unstoppable, is currently failing spectacularly. Additionally, the Wall Street Journal study claims that we are seeing what industry insiders refer to as one of Blackstone's worst recent investments. But senior housing isn't the only issue here. Prices for single-family homes, institutional purchasing habits, and the retirement security of government employees, teachers, and firefighters nationwide are all being affected. With proven losses of over $600 million, Blackstone is liquidating 90 senior home properties, the largest percentage of portfolio losses since the company's creation. Blackstone went on an extraordinary senior home buying binge in 2016 and 2017, purchasing 64 properties from HCP for $1.1 billion and another portfolio from Welltower for $747 million, totaling 9,000 units nationwide. They wagered that the aging baby boomer wave would ensure returns, so they paid hefty premiums. These same properties are currently being sold for 29 to 75% less than what they originally cost. The math is stark. Of just 39 properties analyzed by the Wall Street Journal, Blackstone paid $755 million and sold for $536 million, a $219 million loss before factoring in the $100 million spent on property improvements, insurance, and maintenance. Projected across all 90 properties, confirmed losses exceed $600 million. And that's only what we know so far. Blackstone didn't pay cash. They borrowed $1.2 billion in floating rate debt to finance the spree. When interest rates rose from near zero to over 5% starting in 2022, loan payments ballooned and cash flow evaporated. 24 properties went into special servicing, Wall Street's polite term for imminent default. The institutional money behind Blackstone's senior housing disaster wasn't just from billionaire investors. According to SEC filings reviewed by the Wall Street Journal, major pension funds invested directly in the Blackstone Real Estate Partners 8 fund that purchased these properties. The Arizona retirement system put in $100 million. The San Francisco Employees Retirement System, $150 million. The North Carolina Retirement System, $200 million. And the Pennsylvania Public School Employees Retirement System, $300 million. Arizona teachers alone committed $100 million. Pennsylvania School Employees, $300 million. These aren't small positions. They represent meaningful portions of retirement assets for hundreds of thousands of Americans. And according to the latest pension fund disclosures, these allocations are showing negative returns for the first time since the 2009 financial crisis. The Arizona retirement system has reported significant headwinds in their real estate investments, while Pennsylvania teachers are seeing their Blackstone allocation underwater for the first time in over a decade. The financial losses are only part of the story. In Florida, Blackstone's Aventura property was purchased for $48.8 million and sold for 75% less after regulators found inadequate resident care, unsanitary conditions, and administrative failures. In Greenville, South Carolina, occupancy collapsed from 80% to 41% during the pandemic. The Centers for Medicare and Medicaid Services gave the facility a 1-star rating after investigators found it had incorrectly prescribed antipsychotic medication to a resident in a way that was likely to cause serious injury, serious harm, serious impairment, or death. The property sold for 60% below purchase price. Denver and Chicago tell similar stories, with properties selling for 70% less than Blackstone paid. American seniors weren't getting the care they paid for, and American workers are losing their retirement savings in the process. As one industry insider told the Wall Street Journal, "You're buying an apartment inside a hotel inside a restaurant inside a medical clinic." For Blackstone, that operational complexity proved impossible to manage profitably. Blackstone isn't just a senior housing investor. They're the world's largest owner of single-family rental homes through their subsidiary Invitation Homes. The $600 million loss in senior housing is forcing Blackstone to reassess risk across their entire $71 billion real estate portfolio, including over 80,000 single-family homes rented to regular families. Blackstone is now tightening lending standards and reducing acquisition targets across all real estate sectors, not just senior housing. When the most aggressive institutional buyer in America pulls back, it creates ripple effects through the entire housing ecosystem. The same floating rate debt strategy that destroyed Blackstone's senior housing returns is embedded throughout their residential portfolio. Properties purchased for $400,000 to $500,000 in 2021 and 2022 are now generating negative cash flow as debt service costs have doubled. This means institutional selling pressure isn't limited to senior housing. Blackstone and other private equity firms are quietly beginning to list single-family homes in markets where their purchase prices no longer make financial sense. Phoenix, Austin, Tampa, Charlotte, the same metros where institutional buyers drove up prices during the pandemic. For regular home buyers, this creates both opportunity and risk. Opportunity because institutional selling increases inventory and reduces competition. Risk because when $2 trillion in institutional money starts reassessing real estate exposure, it can trigger broader market corrections that affect everyone's home values. When teachers in Arizona lose retirement money and firefighters in Pennsylvania see their pensions decline, they spend less on housing, cars, and everything else. That demand destruction can accelerate housing market weakness beyond just institutional selling pressure. When the world's largest alternative asset manager dumps an entire asset class at massive losses, it sends shockwaves through the sector. Senior housing construction financing has become more expensive as lenders now view the sector as higher risk. Insurance companies are demanding higher premiums. Even well-run facilities are seeing valuations decline, simply because Blackstone's failure has spooked institutional investors. KKR has announced reduced senior housing exposure. Apollo has suspended new senior housing investments. The institutional money that was supposed to help solve America's senior housing shortage is now fleeing the sector entirely. Blackstone has already sold 70 of their 90 senior housing properties and is in talks to sell the remaining facilities. They have suspended all new senior housing acquisitions and quietly removed the sector from their target investment categories. The National Association of Real Estate Investment Trusts is calling Blackstone's failure company-specific rather than sector-wide. But when the world's most sophisticated real estate investor loses $600 million on a supposedly can't-miss demographic trend, what follows isn't a quick recovery. What follows is a prolonged period where institutional capital avoids the sector entirely. For sophisticated investors who understand senior housing operations, Blackstone's distressed selling is creating buying opportunities that haven't existed since 2008. Properties purchased for tens of millions of dollars are now selling at 30 to 70% discounts. The key insight is that Blackstone's failure was operational, not demographic. The aging baby boomer trend is still real. Demand for quality senior housing is still growing. But managing senior housing requires healthcare expertise, not just real estate knowledge, and Blackstone had the latter without the former. Regional operators with healthcare backgrounds are now acquiring Blackstone's former properties at massive discounts. Welltower, which originally sold properties to Blackstone, is buying some of them back for roughly 50 cents on the dollar. For pension funds, this should be a fundamental wake-up call about the risks of allocating billions to private equity managers who promise expertise in sectors they don't actually understand. 3 signals will tell you how this plays out. First, watch for more pension funds to reduce their Blackstone allocations or publicly demand explanations for senior housing losses. When Arizona teachers' retirement money gets decimated in a Wall Street real estate fund, it creates political pressure for pension boards to reconsider their private equity relationships. Second, watch senior housing construction starts. With institutional financing drying up, developers will struggle to fund new projects. potentially worsening America's senior housing supply shortage even as the demographic demand grows. Third, watch for regulatory changes in how pension funds evaluate private equity real estate investments. When hundreds of millions in teacher and firefighter retirement money gets lost on facilities with one-star Medicare ratings and medication errors, pressure for oversight follows. Blackstone wagered $1.8 billion that operational complexity would be overcome by demographic changes. With almost $600 million in proven losses and pension fund funds carrying a large portion of the expense, that wager is failing catastrophically. As Blackstone continues to sell properties at steep discounts, we are merely witnessing the start of the loss of institutional wealth. Beneficiaries of pension funds saw this as a betrayal of trust since Wall Street's overconfidence was used to gamble on retirement security. It serves as a warning to the senior housing sector about what happens when healthcare realities and financial engineering combine. Additionally, Blackstone's withdrawal from real estate investment, encompassing both single-family rentals and senior housing, is another factor driving inventory higher into a market that is already having trouble finding purchasers.